The stock market feels like a never-ending parade of price hikes. Every chart looks like a steep mountain, and every news article talks about records being shattered. It's enough to make you question whether now is the right time to invest. But here's a question for you. If stocks are overpriced, does that mean you should just sit it out? The truth is, waiting could mean missing opportunities. The key is knowing how to play the game differently. Let's explore how you can navigate an overheated market and still come out ahead. Understanding overpriced stocks. Let's start with this. How do you even know if a stock or the whole market is overpriced? It's not just about the price tag. A $1,000 stock might be undervalued, while a $10 stock might be overpriced. It's about what you're getting for your money. Think of it like shopping. Imagine buying a pair of shoes for $500. If they're handmade and built to last decades, maybe it's worth it. But if they're falling apart after a few wears, you've overpaid. The stock market works the same way. That's where tools like the price-to-earnings, PE ratio, or the price-to-book, PB ratio come in. A high PE ratio means you're paying a lot for each dollar the company earns. It's like buying those $500 shoes that won't last. A high PB ratio? It could mean the company's stock price is way higher than the value of its assets. And here's the kicker. The market today is flashing some serious overvaluation signals. The Buffett indicator, a metric that compares the total stock market value to the size of the economy, currently sits at around 205%. For context, anything above 100% suggests the market is overvalued. At 205%, we're way beyond that. Add to this the fact that the biggest companies, like the top 10 in the S&P 500, now make up nearly 40% of the index. That kind of concentration creates even more risk because if one giant stumbles, it could ripple across the market. So what does all this mean? Overvalued doesn't mean you can't invest. It just means you need to be smart about it. Investment strategies. 1. Diversification. When stocks feel overpriced, putting all your money in one place can be a disaster waiting to happen. That's why diversification is your best friend. Think of it like a buffet. If one dish doesn't taste great, you've got plenty of others to enjoy. So, how do you diversify? Start by looking beyond stocks. Real estate. This doesn't mean you need to buy a house tomorrow. Real estate investment trusts, REITs, are a way to get into the market without needing a fortune. These funds invest in properties like shopping malls, apartment complexes, or office buildings. They generate income and can grow in value over time. Commodities. Think gold, silver, or oil. These are assets that often move in the opposite direction of stocks. When the market is shaky, commodities can provide stability. Alternative investments. This is where things get interesting. Have you ever thought about investing in fine wine, rare whiskey, or even classic cars? These aren't your typical investments, but they're gaining popularity as people look for ways to diversify outside traditional markets. The key here is spreading your risk. If one part of your portfolio underperforms, the other parts can balance it out. 2. Value investing. Expensive markets don't mean every stock is overpriced. Some gems are hiding in plain sight. You just need to know where to look. This is where value investing comes in. It's like shopping for deals, but instead of waiting for a sale, you're looking for stocks that are underappreciated by the market. Here's how it works. Look for companies with strong fundamentals, like stable earnings, low debt, and a competitive edge in their industry. Check their valuation metrics. Stocks with lower PE and PB ratios compared to their peers might be undervalued. Let's take an example. In the healthcare sector, General Electric Healthcare Technologies is catching some attention. Despite being part of an expensive market, it's viewed as having strong potential for long-term growth. Why? Because healthcare is a sector that's always in demand, regardless of market conditions. Value investing isn't about chasing trends. It's about finding quality companies that the market hasn't fully appreciated yet. Third dollar cost averaging market timing is tempting. Everyone wants to buy at the bottom and sell at the top. But here's the hard truth. Even the pros get it wrong. Dollar cost averaging, DCA, is the antidote to this. It's simple, effective, and takes the stress out of investing. With DCA, you invest a fixed amount of money at regular intervals, no matter what the market looks like. If prices are high, you buy fewer shares. If prices are low, you buy more. Over time, this strategy averages out your cost per share, smoothing out the market's ups and downs. Let's say you have $500 to invest every month. You put it into an index fund, whether the market is climbing or dropping. First, so some months you'll get fewer shares for your money. Other months you'll get more. But over time, you'll have built a solid portfolio without worrying about whether it was the right time to invest. DCA is about consistency. It removes emotion from the equation and keeps you focused on the long-term goal. Fourth, dividend-paying stocks. When stock prices are soaring, dividends can feel like a lifeboat. They're steady, reliable, and not tied to market hype. Companies that pay dividends share a portion of their profits with shareholders, usually every quarter. And here's the kicker. Even when stock prices fluctuate, those dividend payments keep rolling in. Why do dividends matter so much in overpriced markets? Imagine a stormy sea. Dividends are like a life raft, providing you with steady income while the waves toss everything else around. Not all companies pay dividends, though. It's usually firms with solid financial health and a history of profitability, like utility companies, consumer staples, or blue-chip stocks. For example, companies in sectors like energy or telecommunications often maintain consistent dividends. Even better, many of these companies regularly increase their payouts over time. That's a double win. You earn regular income, and your returns grow. Now let's talk about reinvestment. Instead of pocketing the dividends, you can use them to buy more shares. Over time, this creates a compounding effect. Your dividends earn dividends, and your portfolio grows faster without you lifting a finger. Dividend-paying stocks are the ultimate set-it-and-forget-it strategy. They reward you for being patient and sticking to your plan, even when the market feels too hot to handle. Avoiding common pitfalls and market timing. Trying to time the market is like trying to predict the weather a month in advance. It's nearly impossible. Many investors sit out, waiting for a crash, only to miss out on gains. The truth is, no one knows when the market will rise or fall, not even the pros. 2. Psychological biases. Have you ever heard about FOMO, fear of missing out? It's real and it's dangerous. Herd mentality can push you to buy overpriced stocks just because everyone else is doing it. Stay grounded. Follow your plan, not the crowd. 3. Concentration risk. Putting all your money in a few popular stocks might seem like a winning bet. After all, who doesn't love the big tech players? But if one falters, your portfolio takes a hit. Diversify to protect yourself from this trap. Investing in an overpriced market doesn't mean sitting on the sidelines. It's about playing smarter. Diversify your portfolio to spread risk. Hunt for value stocks that others overlook. Use dollar-cost averaging to stay consistent and look to dividend-paying stocks for reliable income. Avoid the temptation to time the market or follow the crowd blindly. Now it's your turn. What's your favorite strategy for investing during times like these? Drop your thoughts in the comments. If this video helped, hit the like button, share it with a friend, and don't forget to subscribe to our channel. Turn on the bell icon to stay updated with more tips that help you make the most of your money. Let's grow smarter together.